We're going to break this down simply and help you understand the Fed. Oh, you're going to sound so smart and be so smart after this video. Hi, I'm Keith Weinhold. This is Get Rich Education. Okay, so following the Fed is not a great spectator sport like watching the NBA Finals or seeing motorcycles jump off ramps, but their decisions affect your interest rate, which is your cost of money. So this is really worth understanding. Now, currently, the economy and the GDP are both growing faster than expected, so the Fed has jumped in, and in the recent meeting, for example, they said that, hey, we're soon going to need to hike interest rates. You can see this article here. They talked about hiking interest rates by 2023. One of the Fed members here even says by next year we might have to do this. So what's the meaning here, and why does this matter? First of all, an interest rate hike means an interest rate raise. Hike means raise. I wish they would just say raise. Everyone understands what that means. Now, why would the Fed ever raise interest rates on you? What does that do? Well, just think about it. It helps slow inflation because it cools an overheating economy. Sometimes it helps to use extreme examples to help drive the point home. Say interest rates were really high, like 15%, which is realistic. That did happen in the 1980s. Well, think about it. If interest rates were that high, how willing would you be to borrow, to grow or expand a business, or take on a new mortgage loan, because those rates would be really high too, in order to buy a new investment property or even buy a home? Well, not very likely, because that interest rate, 15%, is really high if it got hiked or raised up there so many times. So that cools an economy because it gets fewer dollars flowing in the economy into new business and new investment. And what else would a higher interest rate do to you? That would incentivize you to save, because you could get, say, 15% in your savings account. That takes dollars out of circulation that would have otherwise been in the economy. So that's what raising interest rates does. Because if you had more dollars flowing in an economy, what you basically are is a bidder, and you're driving up the price of those items. That can't happen so much if interest rates are high. Okay, so why exactly does the Fed raise interest rates to keep the economy from getting too hot and making inflation too high anyway? Actually, what in itself is wrong with a high inflation rate? Well, a really high inflation rate, that makes consumers lose faith in the currency. That makes them lose faith in the purchasing power of their dollar. And this can create a snowball effect, because think about it. If you've lost faith in the purchasing power of your dollar, then you're going to go get rid of even more dollars and drive inflation ever higher. And it could be a vicious cycle, really heating up the economy. High inflation also tends to create variable inflation, and variable inflation is really disillusioning to people and especially businesses. It makes it difficult for businesses to plan. Time is money. And imagine if you're a business and you had to effectively plan for there being 35 days in this month and 22 days in next month, and so on. It would really get confusing. So it's really a bad thing to have inflation that's too high. People lose faith in the currency and they can't plan. That's why higher interest rates are used as a tool to help head off inflation by the Fed. Now, oppositely, why would the Fed lower interest rates? Let's look at that. And before we do, let's look at the federal funds rate. This is the name of this baseline rate that the Fed sets. And we're just going to take a look at the last 5 years here. You see rates in 2016, 2017, 2018 crept up until they plateaued around 2019, and then they dropped quickly once the recession kicked in. They basically have dropped to zero, which is where they still stand now. So why does the Fed do this? Why do they often drop rates in a recession? And they've been dropped ostensibly as far as they can possibly go here, effectively at zero. They do that in order to help stimulate a sluggish economy. If interest rates are really low, again, I would just ask you, if they were, say, 3%, how would you be incentivized to behave? Well, now you'd be less incentivized to do things like save money, and you'd be more likely to take on loans at low interest rates for things like starting or expanding a business or buying investment property. You've got dollars moving again in the economy, making new investment. That's what helps the economy pick up steam. And with what happened 1 year ago, you can understand how the Fed is very important with all the layoffs being made to try to get some economic activity. Basically, we're going to need all the help that we could get. That's why rates were lowered in order to help get an economy heating up again and get dollars flowing. So basically, interest rates, this tool is very important for the Fed to kind of keep the economy in what some call a Goldilocks zone. Not too hot and not too cold. Hey, if you would, put a YouTube like on this video. You don't have to, but that tells YouTube that it's a good video, and it will make it more likely that videos like this will show up in your feed if you put a YouTube like on it. You sure don't have to, but I'd really appreciate it. Now, understand that when interest rates are hiked, which as we've established means raised, that affects short-term interest rates. Things like home equity lines of credit, and bank loans and credit cards. In fact, those vehicles often move in direct lockstep. Therefore, if the Fed announces a quarter-point interest rate hike, you can expect the interest rate on your home equity line of credit to very soon step up exactly 0.25%. So these Fed decisions affect short-term interest rates. A big misconception is that Fed decisions directly impact long-term interest rates like they do on 30-year and 15-year mortgages. That is false. The mortgage interest rates on 30 and 15-year mortgages, they're loosely correlated to what the Fed is doing. If the federal funds rate's really low, then long-term rates really aren't going to be high. But what you want to remember is that long-term mortgage interest rates, long-term rates like that, are tied to the yield on the 10-year Treasury note. Sometimes you might hear it referred to as the yield on the 10-year T-note. So you want to follow that yield in order to look at what's happening with long-term mortgage rates. So that's not what the Fed's involved in. As real estate investors, of course, all these rates are huge as we tie up long-term fixed interest rate debt. But when we get back to this rate that the Fed sets, called the federal funds rate, if the federal funds rate appears likely to rise, like the Fed just recently announced in a meeting that it's soon going to rise either next year or the following year, that makes the stock market fall. Oppositely, if there's news that the federal funds rate is going to go down, meaning it would stimulate more economic activity, the stock market tends to rise. They like that news. Now, we call it the Fed, but otherwise it's expressed as the Federal Reserve or the Federal Open Market Committee. You might even see that abbreviated, FOMC, in the media. It all basically means the same thing. So the Federal Reserve has what they call a dual mandate, two big missions, and that's to pursue maximum employment and stable prices. Those two things are really why they exist, and setting interest rates is one of the big tools that they have for doing this. The other one is enacting policy in order to create more currency and getting more dollars flowing through the economy. That's the dual mandate of the Fed. The Federal Open Market Committee has 12 members, and they manage the United States money supply. Now, sometimes you'll see the media use terms to describe the Fed's behavior. You often see them say that the Fed is either being hawkish or being dovish. If the Fed is hawkish, they're talking about the Fed being aggressive in getting in and want to tweak policy or raise rates. And if the Fed is being more dovish, they're more willing to just lie back and not change rates and sort of see what happens and be more passive if they're being dovish. And the Fed has 8 regularly scheduled meetings per year, and it's at these meetings where they announce if an interest rate change is going to take place. Usually it's only a quarter point at a time. They don't want to jar the economy and markets too much. Sometimes you'll see a half point adjustment. Financial markets watch these meetings really closely. The President of the United States is the one that nominates a Fed chairperson to lead these 12 members, and they have a 4-year term. You probably know that the current Fed chair is Jerome Powell. A lot of people like Jerome Powell because he's much more transparent about what is going to happen. We had some previous Fed chairs like Alan Greenspan where He kind of spoke in this Fed speak, this language you'd have to try to decipher, and people were looking up, oh, he used the word moderate here and modest here, and what's the difference and what's he really mean? Jerome Powell's quite open, so whether you like his policies or not, people do like the fact that he's pretty open about what they plan to do. But the president and the Federal Reserve chairperson are supposed to remain independent from each other. However, former President Donald Trump has basically said some things to Jerome Powell like, hey dude, chill with the interest rate increases. And he said that publicly, something that they shouldn't do. Those two bodies are supposed to stay independent from each other. See, presidents don't want to see interest rates raised under that president's watch because that tends to slow the economy and it makes that president look bad. Presidents generally want to see the Fed lower interest rates, get those dollars flowing, get people like you investing in income property or borrowing to start or expand a new business. Presidents like to see rates be lowered under their watch. Again, they can't get any lower than they are now. They're basically at zero. They can only go up from this point. Understand that we've been talking about monetary policy. That's enacted by the Fed. That is interest rate policy, and currency creation is what the Fed is involved with. Monetary policy. Let's not confuse that with fiscal policy. Fiscal policy is enacted by the president and Congress. Fiscal policy basically means tax and spend, not currency creation and interest rate creation like we have over here with the Fed. That's the monetary policy. The fiscal policy is tax and spend. And within the president and Congress, it's the powerful House Ways and Means Committee that has the most influence at setting that tax and spend fiscal policy like we have over here. They come up with the policy, and then that fiscal policy is enacted through the Treasury, which is headed by Janet Yellen. Hey, and Janet Yellen is the former Fed chair. She used to have the position that Jerome Powell has now. So yeah, here the Treasury Secretary, Janet Yellen, she resembles my grandma Weinhold an awful lot. You might remember from a few years ago on the Get Rich Education podcast, whenever I played a clip from Janet Yellen, I would often call her Grandma Yellen. She looks a good bit like my grandma. Maybe not too much like my grandma, but I'm not always looking at photos of 80-year-old women. So anyway, I see part of my Grandma Weinhold in Janet Yellen. But that's the difference between, again, fiscal policy, which is tax and spend, and monetary policy, which is interest rate decisions and currency creation, which is done by the Fed. Let's not confuse monetary and fiscal policy. Hey, put a YouTube like on this video if you like the value that you're getting from it, if you like how you think I'm breaking it down clearly and concisely for how the Fed works and why it actually matters to you, since it does affect your cost of money. And by the way, there is way more to the Fed. This is just a pretty basic, keep it simple overview without getting down into the weeds too much. And though the play-by-play is about as interesting as watching your neighbor whack weeds, know that the Fed controls interest rates, currency creation, and your cost of money. That's why it matters. Well, their decisions are a big deal. They move markets. Here's a look at the calendar, the upcoming calendar for the last 4 meetings that they'll have this year. I told you that the Fed meets 8 times a year. If you kind of like this conversation and you want to keep it going and make it portable, download the Get Rich Education podcast. I'm there talking every week about economics in real estate investing and wealth mindset. Either the Get Rich Education podcast or Get Rich Education app are a way to listen to me where I really try to make things clear and simple and understandable to you and also tell you why they matter. My name's Keith Weinhold. This is Get Rich Education. Thanks for being here, but you weren't here for me. You were here for you. We'll see you in the next video.